Hello everyone, and welcome to the release of the January 2022 Business Risk Index results. I'm Michael Pollack, Head of Content at CreditorWatch, and I'm joined today by James O'Donnell, the Managing Director of Open Analytics and creator of our index. Welcome, James.
Thanks, Michael. It's always good to join you for these sessions.
We've got a lot of interesting results to chat about today, so let's just get right into it. First of all, for those of you who are new to our webinars, just a bit of background on what we do at CreditorWatch. We're Australia's leading commercial credit bureau, helping businesses of all sizes to manage credit risk, minimise fraud, and know their customer base better and avoid bad debts. So we have a suite of tools ranging from customer onboarding, helping with due diligence, alerts and monitoring, credit scores, through to analytical tools and debt recovery tools. We have more than 55,000 customers. We're collecting data on more than 11 million trade lines from integration with Xero and MYOB and ATB data. So let's get into the data, James. Sorry, before we get to that, my mistake. Before we get into that, we'd like to run a poll on who is actually joining us today. What size business do you have? Just so we have an idea of who we're speaking to, so we can tailor things precisely for our audience. Okay, so a bit of a mix today between SMEs and mid-tier businesses. Thank you for your results. Okay, so the BRI for January 2022. Now, obviously, we reported in December that trade activity was down quite a bit on December 2020, around 45%. So a significant drop there. We're seeing that slide in trade receivables continue into January 22. You know, it's Omicron, obviously, that's having the biggest impact on businesses with supply chain issues, labour shortages, skills shortages. It seems like, you know, SMEs are just copping it from all sides at the moment. Now, concerningly, this month as well, court actions have jumped 58%, James. So we're seeing the banks and the ATO, it looks like they're getting back into their regular collection cycle. So that's obviously not a good sign for insolvencies across 2022. Do you just want to?
Yeah, absolutely, Michael. So look, I'll dive into the detailed results. So as Michael mentioned, so I guess the top level findings, what we're seeing this month is really, we're seeing a turning point really for insolvencies and court actions. So the last few months we've been reporting this turning point sort of evidenced by predictions and models. So our models have been sort of suggesting the lower than average default rates have bottomed out, and that's, you know, things are about to start getting a bit painful for creditors and for businesses. I'd say this, you know, when we compare this quarter, we're seeing the first, if you like, hard evidence of that through the court actions, and actual insolvencies are up quarter on quarter as well for the first time in a long time. So I think what would sort of, everyone should be prepared for quite a steady increase in defaults and insolvencies over the rest of 2022, and I'd say that's pretty much true across all regions and estates across the country. The third sort of key highlight is, you know, after, you know, we reported the worst Christmas trading period we've seen in our data history, and I'd say that the January month sort of confirms that. So really, yeah, Omicron has been really a big setback for the economy more generally, but particularly hospitality, tourism, and retail trade businesses. All right, so just to show some of this data, so I'll start with external administrations. So this chart shows a bit of a long history of monthly number of external administrations. Now, what I've done is I've highlighted the the most recent quarter and the current month. So the dark blue is comparing the January on January. You normally see in January insolvencies and external administrations and enforcements in general drop. Basically, everyone's on holidays, including debt collectors in January. But if you just compare the quarter, so a rolling sort of most recent quarter to the same period last year, it's actually now up sort of 7%. Now that hasn't been true for almost 2 years now. So we're really seeing the clear evidence that insolvencies have bottomed out and are starting to increase. Another really good leading indicator is court actions. So you can see here, same sort of chart, but now just looking at the number of court actions during the month. So you can see this quarter's court actions actually up more than 50% on the same quarter last year. Now, court actions really are a good leading indicator of insolvencies. So the normal sort of progression to insolvency that we see, normally the first indicator you see is trade defaults. So we tend to see businesses start defaults on a business that's struggling to pay its debts. Then the court actions, and that's the third step in the process is generally when the liquidators come in and creditors are trying to get their money back. So there's multiple signals that are sort of pointing to insolvencies and defaults rising. The trade receivables data, a bit of a different way to present it this month. Again, you can see, as we've been reporting for a while, this sort of last quarter, it's down 45% compared to the same quarter last year. And look, that's obviously really driven by Omicron. I think for those of you with a long memory, you even not so long a memory, you'd recall sort of over the last couple of months, I've actually been quite upbeat on where I think things are heading. And Omicron, I'd say it's worth pointing out, it really has already caused some damage. So there's various public statements from the Reserve Bank that's still sort of remaining pretty optimistic, but it's really important to point out that a lot of those sort of tourism regions and retail trade have already had basically half of their summer trading wiped out. So even if, as we all hope, we sort of bounce back pretty quickly, there's already some damage done, if you like. And then finally, to finish off the high level findings, that all of those signals are really confirming what our models have been predicting for a while. So credit scores have deteriorated, and we're tending to see across the board insolvency rates are predicted to go up. In terms of to quantify that, we're generally expecting about a 1% increase in insolvencies pretty uniformly across the country over the next sort of 12 months is what we're expecting to see. Okay, so that's the headlines. So moving on to some more sort of detailed sort of regional results. So we'll go state by state, starting with New South Wales. Now this table comes from the Business Risk Index website. So what we're reporting here is in New South Wales, all regions with at least 500 credit active businesses. So the table on the left shows the region. Then you'll see the two default rates there. So there's the first column is a default rate that the region has experienced over the last 12 months. So what percentage of businesses have gone under external administration. Then the next column is what we're expecting over the next 12 months. And then the final column there is the projected change. So you can see in general, they're all in the red. So basically, it averages out to about 1%. So about 1% increase in insolvencies we're predicting over the next sort of 12 months. The colour code is based on the Business Risk Index, which some of you will recall is basically a ranking of regions by their insolvency risk across the country. There's about 300 odd regions that we essentially rank and put on a 1 to 100 scale. So basically green means you're faring better than the national average. The red down the bottom of the table, are really the highest risk regions. And then the amber is basically anything with an index under between sort of 20 and 35. So within New South Wales, it's really northern Sydney that's faring the best, sort of places like Lane Cove, Pittwater, then also some of the bigger regional centres like Newcastle and Wollongong. The other end of the scale, as we've been reporting for a while now, is pretty much exclusively Western Sydney is sort of faring the worst in New South Wales.
Encouraging
Victoria,
though. Sorry,
just Michael.
if you go back to that previous slide, it's encouraging to see the Strathfield, Burwood, Ashfield area moving up. It was obviously last year one of the areas that was under hard lockdown and not faring too well on the index, but some encouraging signs there.
Yeah, so that part of Western Sydney has actually bounced back. It's actually moved up the ranks on the index quite a bit over the last sort of 6 months, and it's now sort of sitting in the average sort of range there.
Sure.
Victoria, as a state, a lot of similarities to New South Wales. You know, about the same kind of average risk across the state, and similar sort of thing where you can see Melbourne City there is in the amber there. So we're actually quite pessimistic on, particularly retail trade businesses and hospitality businesses in the Melbourne CBD. The best areas in Victoria really are, carrying on from the theme we've been reporting for a while, places that are sort of agribusiness or manufacturing, places like Geelong, the wineries region in the Yarras, kind of among the best performers in Victoria. Queensland, I'll apologise in advance for the scale's a bit score on this. There was actually a lot to cram in on Queensland. Queensland's the highest risk state. It's probably got more of the amber and red than any other state. Now, an interesting one that we haven't reported on before, we've talked a lot about the Gold Coast, which is there in the red, and I probably don't need to belabor that point, that area is struggling. Far North Queensland really is among all the sort of lowest risk regions in Queensland. So sort of centred around sort of Townsville and then sort of other regional areas like Mackay and around Ayr. Basically, the economy is driven by a couple of things. One, coal mining, and the other one is a big sort of sugarcane area of the country. So those sort of agribusiness areas around there are actually doing pretty well, but the state as a whole, is actually the weakest performer at the moment. Western Australia, again, probably repeating a lot from last time, that really sort of the mining industry and agribusiness is also sort of propping up Western Australia. Perth is one of the few major city centre CBDs which is actually in the green or better than average. So Perth City is actually doing quite well, and generally speaking, WA is doing quite well overall. And then just to finish off, a couple more of the smaller states, and to start with the lowest risk states, so basically South Australia and Tasmania, really the lowest risk regions in the country, and basically almost every region in those two states are in the the top half. So generally, a lot of the drivers there, it's not necessarily saying that the GDP is booming in those areas in terms of cash flow. It's more sort of a case of sort of quite low insolvency risk in those regions. So both South Australia and Victoria are a good place to run a small business at the moment. And then finally, with sort of the national capital and territories, so NT and ACT, also generally quite low risk. Canberra's a bit of an interesting one. You've got a bit of the government bubble there. So Canberra's sort of ticked along nicely, despite everything else that's going on in the rest of the country. All right, so that's the sort of state view. I think the one thing we've been talking about quite a bit is Western Australia. Yes, it's been going well over the last 12 months, but what's going to happen now that they are looking to open borders? So I think, park a question mark there. I think, is there a risk that Western Australia will start to feel some of the issues that Victoria and Queensland and New South Wales have been experiencing over the last sort of 12 months. So I think Western Australia is definitely a case of sort of watch this space. To just finish off with some industry insights on sort of the lending market and sort of credit inquiries. So credit inquiries, really the story, a quarter-on-quarter view is basically dead flat. So the number of credit inquiries over the last sort of quarter is basically exactly the same as it was sort of the same quarter 12 months ago. This is an interesting one for me because I know that some of the big four banks who we talk closely with all the time have actually released some positive numbers on credit growth specifically for the month of January. So it's kind of a bit interesting. Do these results sort of contradict that in some sense? And what we sort of think that is that banks are still very cautious on their running at the moment, and they're moving people out of hardship arrangements and things like that. So I don't think banks are necessarily doing lots of new business, but what I would speculate is that banks are tending to do more credit to established customers with good financials and behavioural data. So basically ones where you'll do a top up of existing credit without necessarily doing a bureau check. So that's where I think those numbers can be sort of pointing in different directions because of that sort of feature. And then just finally, just the industry view of probability of default and arrears. So starting with the PDs, again, sort of the food and beverage services, hospitality, obviously keep a close eye on that with sort of how Omicron and the residual of these restrictions play out at the sort of high risk end of the scale. Pretty consistently over the last little while now, sort of the top performing is really agribusiness, mining, and the healthcare sector, with sort of manufacturing and wholesale trade faring pretty well also. Basically, industries that aren't necessarily affected that much by lockdowns. And then on sort of payment history, again, as always, the construction, project finance, affected payments, more arrears for the construction industry. The next one there, transport, postal and warehousing, that's an interesting one. It's probably worth pointing out that these sort of ANZIC or standard industry classifications have some broad populations in them. It's probably worth pointing out that the transport industry also includes taxis and Uber drivers, and we know that they've actually been affected quite a bit by the lockdowns. And then, of course, accommodation and food services linked to hospitality, and also, the hospitality and tourism industry there. At the other end of the scale, healthcare, agribusiness again, and sort of education and training are sort of the best payers across the industries.
And they're, of course, heavily government supported, James.
Yeah, that's true. I think if you look more broadly speaking, look, I think there's some optimistic on education. Obviously, the university sector is a big chunk of Australia's economy. It sort of rivals sort of the mining industry. That's obviously been hit hard, but can weather the storm with, obviously government backing. Really important that those sort of international students flow back into the country, and I know that that's the intention from both the government and obviously the universities as well. So that'll be one to keep an eye on as well.
For sure.
All right, so look, that concludes all the facts and figures. So I think I'll hand back to Michael and sort of cover off if there's any questions that come through on the poll.
Yeah, thanks, James. As always, some really great insights there, and some things to look out for the remainder of 2022, particularly, as you said, around what's in store for WA as it opens its borders to the rest of the country and the world, I guess. So yeah, as James said, please, if you've got any questions, post them through the GoToWebinar control panel on the right-hand side of your screen. We'd love to hear from you. While you do that, we are running a poll ourselves as well on just on whether you'd like to be contacted by a CreditorWatch representative. We'll run that now. Thank you for that. All right, well, that concludes our webinar for today. Thank you for tuning in. Now, if you'd like some more information on the Business Risk Index, if you'd like to explore the data in more detail, please head to creditorwatch.com.au/business risk index. You will find our interactive map, which covers default risk for more than 300 regions across Australia. So we encourage you to go in and have a little play with that. It's very easy to get stuck in there for a while, exploring all the data. We also have our industry synopsis, so you can look at the industry by industry breakdown and the data there. So yeah, that's it for this month. We'll be back next month with the February results. Until then, stay safe and thanks for joining us.